Welcome back, everybody. Now, I was one of the people who was adding big tech to my portfolio in 2024. I already owned Apple, but I added Amazon, I added Google, I added Nvidia, and I added Meta. And while there's nothing inherently special about that, I mean, they were pretty obvious, at least in my opinion, but I got a lot of questions about why are you adding overpriced big tech stocks into your portfolio in 2024 when they already had a big run up in 2023? And the simple answer from me was, I didn't think that their run was over. And based on the fundamentals, they looked more attractive to me than some of the other more, quote, traditional companies. But the question now is, okay, well, sure, 2024 was also a big year for big tech, but they can't possibly do it again in 2025, can they? Well, we're going to talk about it, and I'll tell you why I'm pretty comfortable being top heavy with big tech in my portfolio going into next year. And just FYI, today's video is going to be a little bit less polished, just kind of us talking about the market news and ideas here. But as I was putting this video together, funny enough, this article came across on Seeking Alpha. That's basically UBS saying the tech mega caps will lead again in 2025. And if we go through the article, there's some interesting things here that I want to point out. Now, they talk about how the six stocks in the S&P 500, basically Apple, Nvidia, Microsoft, Amazon, and Google, have returned 149% since 2023 with, and this is important in my opinion, earnings per share growing 93%. And they break it down more here where they say the overall growth number for technology, and they're using XLK, and I'm not even going to try to say that word because I know I will screw that up. But it basically masks the difference between the big six and the remainder of the group. Because he's saying in 2024, for example, the big six earnings per share expanded 38% versus 12% for the rest of the tech sector. So again, they're saying that the big six stocks basically have outgrown the smaller tech stocks and they've really pushed the index up. And it's true of the S&P 500 as well, right? They've really dominated a lot of those gains. And especially when you talk about just earnings growth, which is one of the main things and reasons why I've been buying them in 2024. But they talk about for 2025 that this gap is expected to close with the big six growth modestly lagging the rest of the group, 19% versus 21.5%. So what I take from this is two things. One, that they believe that tech broadly is going to perform very well in 2025, which, okay, seems like a pretty good bet. But they're also saying that the big six growth in terms of earnings per share should come down from 2024, but still be around 19%. So there's a couple of ways you can look at that. You can say, well, okay, maybe they're going to start coming down in 2025, but I'm looking at it kind of the other way of, look, if I can get 19% earnings per share growth on average for a company that's extremely strong, that's making a ton of cash and has a really good balance sheet, that is a very attractive opportunity depending on what your goals are, obviously. Now, are they going to grow the most in the market out of, all the companies? Maybe not. We don't know. We'll have to see. But still, that's a pretty solid outlook for any company. And when you start to look down the line at some of these more traditional companies, when you say, okay, let me take a Starbucks or Hershey's, and I know I always pick on those, but that's because I used to have them in my portfolio. When you look at where they're trading at from a value perspective and you look at their potential outlook for 2025, I mean, it doesn't look nearly as good, right? So I think there's this tendency for us to say, look, these stocks have returned 149%, or this stock has doubled over the past 2 years. It can't possibly go any higher. But if you're looking at the actual data, they still look pretty attractive. And especially when you start comparing it to other companies that maybe haven't performed so well. I think we automatically assume, hey, this stock is down 30%. It must be trading at an attractive multiple. But then you look at it and you're like, ew, that's actually not very good at all. And you can see the difference in the earnings per share revisions in 2024 for the big six versus pretty much everyone else. So this article really sums up a lot of the point of view that I've had with these big tech stocks over the past year is that we're looking at the price, we're seeing that it's gone up a lot, and we just assume, oh, they must be overpriced. They're overpriced tech stocks, right? Which is what people tell me all the time. But when you start accounting for actual growth, and in this case, we're talking about earnings growth, but you can use cash flow growth or free cash flow growth, whatever your preference is, those things start to look really good. So we always have to look at a company's valuation in relation to the growth that you expect from the company. Because at the end of the day, something that's super cheap, that's trading at a cheap multiple, may be cheap because there's no growth in that company on the horizon, right? So Hershey, I think, is a great example of that. Like, where is the growth actually going to come from? And when you actually look at what it's trading at, you realize it's not trading all that cheap anyway. But not only do the big tech companies have earnings growth that's really outpacing a lot of the market, they're also the companies that, in my opinion, are most likely to survive a recession if the economy starts to go the other way. And I think this is one of the dangers that we're not talking about enough anymore, because now everyone's like, oh, growth is back and all these things are going up. But the way that I look at it is the market is at an all-time high. Inflation numbers are probably worse in reality when it comes to what we actually experience than what we're hearing in the headlines. And you see things like consumer debt is now at an all-time high. Those are things that usually, in my opinion, wouldn't really end well, or means that we're going to hit a little turbulence in the economy, maybe more so than people are projecting right now. Now, obviously, if there is a recession, then every company is going to be impacted on some level, but I do think a lot of these big tech companies are going to be more insulated from it than maybe the broader market. I mean, let's take NVIDIA, for example. Their customers aren't just everyday consumers anyway. Their customers are primarily big tech companies that have a lot of money. And if you look at ones like Microsoft, they have a lot of enterprise subscriptions, right? Now, there may be a slowdown there depending on how businesses are doing overall, but it's not going to be the same type of hit as if you're a consumer-facing product. So maybe like Apple would take a bigger hit than a Microsoft would. So the idea that they're just overpriced tech stocks to me really doesn't make a lot of sense, especially if you're looking at the fundamentals. So I'm looking at 2025, like if you can put your money in some of the strongest companies in the world, you can get on average about 20% earnings per share growth. And you know that regardless of what happens, they're likely going to be some of the strongest companies in the market. To me, that's a pretty attractive combination. But let's talk about a couple specific ones. And let's start with Apple, because, Apple's the one that most people talk about as being supremely overvalued, trading at a premium. Where's the growth going to come from? There's no growth, right? And we've talked about a lot on this channel about where I think the growth is going to come from for Apple, of how they're kind of in that mode to where the iPhone refresh cycle is still kind of playing out in terms of patterns from the past. Now, is that growth going to come back or not? What I've said is it should come back maybe over the next 12 to 18 months if it's going to come back. Subscription revenue continues to grow, which is great, but it's still not enough of a percentage of revenue that the iPhone refresh doesn't matter. It will matter at some point. And so I do agree from a basic fundamental standpoint, Apple is trading at a premium, but look, people have been saying this for over a year. And then Warren Buffett started selling Apple and people said it was over for them. And yet, here's Apple up about 25% or so since, outpacing the market. Now, obviously, the first thing to realize with this is that nobody really knows what's going to happen in the market. Even Warren Buffett, as great as he is, he doesn't really know, right? He's making educated guesses and doing what he thinks is right at the time. But one thing that these big tech companies have done extremely well is continue to expand their reach and integration into our lives. And Apple's no different, and their new holiday commercial is proof of that.
No, this is...
I got the moon.
Light the fire. You place the flowers in the vase that you bought today.
Another guitar.
I'm so excited. Here you go. Haley.
Happy birthday. Look at the picture of me and you, Daddy. Look at the moon.
Now, that's just a short clip. I didn't play the whole commercial, but if you haven't seen it yet, I highly recommend you go watch it. I'm a dad. I teared up. It's amazing. Apple's awesome. But the messaging here is clear. It's not just trying to sell you some new AirPods. It's AirPods are your hearing assistants now that allow you to experience your children's lives better than you could before. And recently, Tim Cook had an interview where he talked about Apple becoming more prevalent in health tech. He said, "It's clear to me that if you zoom out way into the future and you look back and ask what Apple's biggest contribution was, it will be in the health area. That's what I really believe. When we started pulling that string with the Apple Watch, it was a cascade of events." And then he continues, "I've gotten so many notes over time from people who would not have survived had it not been for the alert on their wrist." Now you realize how big of a statement that is. This is a company that created the iPhone, arguably the greatest tech invention ever, saying that, you know what, health is going to be a bigger impact for a company than even the iPhone was. And when you see messages like, "I wouldn't be alive if not for my Apple Watch," those are pretty powerful words, and it really hits on some of the unique characteristics that Apple has as a company. It's a company that We trust more than the other big tech companies in terms of our data and privacy. Their products are already ingrained into our lives, and now we're talking about more and more of our health data and health monitoring is going to be done by Apple devices. And so I know what some of you are saying, like, yeah, all that feel-good stuff is nice, but where is the growth going to come from? Because growth is what drives stock price. And in general, I do agree, and I can't tell you exactly here's where, Apple's going to get back to double-digit growth, but how I'm looking at Apple is slightly different than maybe how I'm looking at Meta or even Google or any of the other big tech companies. Because the reality for me when it comes to Apple products is you couldn't pay me enough to have me give up my iPhone forever. And I'm a person that I've actually tried Android phones. I had a Pixel for a while. Actually, I had multiple Pixels for a while, and they were pretty good phones, but you couldn't pay me to give up my iPhone. That's how attached I am to it. That's how much it's integrated into my daily life. And I think there's a lot of people out there who kind of feel a similar way. And I know that for some people, that's not enough to justify a high premium, but the comparison that I would make is how people look at Costco. Now, I know Apple and Costco are two different businesses, but just bear with me here. Costco's premium is not because of growth, right? The premium that you pay for Costco, which is a very high premium, even higher than Apple's, is because of the stability and their business model being so strong in terms of dependable revenues and customer loyalty over time. And it's the same thing I think about Apple. Their customer loyalty obviously is off the charts, and over 90% of their customers don't ever want to get another type of phone. That's only going to grow as their subscription revenue grows and as they get more integrated into our health data and health monitoring. So this is just one of those scenarios where I know we can look at a bunch of data, we can look at a bunch of numbers, and we can say, you know what, this is well overvalued and no one should pay this and this is irrational. Even if the growth ends up not being as strong as it's been in the past, I simply look at it as here's a company that has a product that I'm unwilling to give up at almost any price. And now they're getting more ingrained in terms of how we maintain and improve the health and the health of our loved ones. So why wouldn't I want to continue owning a piece of a company like that? At least that's how I look at it, and I think there's a lot of other people who feel the same way. All right, so next up, let's talk about Meta, and specifically about how they're now next to jump into the nuclear energy pit like all their other rival big tech firms. And this is something that we've heard about over the past few months where Microsoft had an announcement, Google had an announcement, Amazon had an announcement. Basically, everyone is partnering now with these energy companies to try to get access to nuclear energy going forward in the future. And now Meta is the next to kind of put their name in the hat, where they basically said they're looking to bring nuclear reactors online starting in the early 2030s to power and support AI data centers and surrounding communities. And the main thing that jumps out at me when I see this article and the previous articles for Google and Microsoft and the rest is that the AI trade is nowhere near coming to an end. And what I mean by that is these companies right now are planning for 2030 and beyond. Like if you look at the actual dates that they're claiming in these articles, they're well out into the future. Like Microsoft's, I think, was 2028 of coming online for the first time. Meta said 2030s. Amazon said 2030s. Google said 2030. So you have all these tech companies that are looking out 4 to 5 years at minimum saying, we know that our energy needs are going to be crazy and we need to start securing cheaper energy sources going forward. And what this reminds me of is comments that Jensen Huang has made about the transformation that's taking place.
The world has installed about $1 trillion worth of data centers. Those $1 trillion worth of data centers uses general purpose computing. General purpose computing is run its course. We cannot continue to process that way. And so the world is going to accelerate everything. Data processing, you name it, okay? And so we're going to accelerate everything. When we accelerate everything, every single data center, every single computer will be an accelerated server. Well, there's about $1 trillion worth of computers, if we don't grow at all, over the next, call it 4 years, that we have to go replace. 4 years, 6 years, pick your number of years. But if the computer industry continues to grow at some 20% or so, we'll probably have to replace over the course of next, pick your number of years, about $2 trillion worth of computers with accelerated computing.
So his timeline of 4 to 6 years and the $1 trillion to $2 trillion of investment kind of lines up with the timelines in these articles for these big tech or cloud providers of how they're building their data centers. And this is why I think the AI trade, or the NVIDIA trade, if you want to call it that, is going to continue for a while. Like, yes, of course, Amazon and Microsoft and everyone are working to create their own chips and not be as dependent on NVIDIA, but we're talking about $1 to $2 trillion over the next 4 to 6 years. So even if you assume more conservative growth rates for NVIDIA going forward, I still think you're looking at market-beating returns for a while. Now, obviously, plans can change and these can be scrapped if these companies don't see their return on investment, but these aren't new hot startups that are just trying to find their way. These are some of the most dominant, cash-rich businesses in the world that are full of tech leaders who see this going out to 2030 and beyond. But that's just my take on it based on what they're doing and what they're saying, and that's why I don't really worry about having NVIDIA as my top-weighted holding going into next year. All right, so let's wrap up some thoughts on big tech in 2025. Now, to me, big tech is the most obvious value play, and it sounds crazy, but I've been saying this for a while. If you look at the fundamental data, they're the strongest companies out there. They still have good projected growth rates, and their balance sheets are really healthy compared to maybe some of the other companies out there. But I do agree that the market has been on a really crazy run-up to all-time highs, and so it seems like a market correction is inevitable. And I'm not saying that's not going to happen. What I'm saying is, even if it does happen, my preference is to have my money in the strongest companies out there, regardless of if they've already gone up a lot over the past 2 years. To me, that's a much better approach than hoping that some company that's down, who still has no earnings, is going to all of a sudden come up. So I do think that big tech is going to continue to do well in 2025. And for the most part, finding quality entries on any dips for these companies is likely going to end up being a very good decision. But that's just my thoughts on it. So lastly, I just wanted to touch on the UnitedHealth news from yesterday. I'm not going to recap what happened. I'm sure you guys heard about it. Just an unbelievable kind of story in terms of what happened and how it happened. But this visceral reaction to UnitedHealth, or healthcare companies overall, is one of the reasons why I sold UNH earlier in the year. Now, UNH is a really strong company. They've actually gone up a lot since I sold, but I was uncomfortable with this idea that healthcare, especially in America, is going to continue to be this thing that's very polarized. It's going to be this thing that's very scrutinized, and in general, people hate it. So that was one of the reasons why I wanted to get out of the stock, right? Because I think it's going to continue to be an issue where you have public sentiment, where you have maybe even intervention by the government, that it's going to be at odds with the company's ability to be profitable or to have really good earnings, right? And at the end of the day, I'm not saying that that's right or wrong. I'm not saying that a healthcare company's number one priority should be earnings, right? That's, I think, part of the debate that people are having. But, it may not impact the stock long term. I have no idea. That was just part of the risk that I was uncomfortable taking going forward, and why I did what I did. So obviously just a really sad story, and much bigger than any portfolio gains or losses that we have. I just think it's something that's going to continue to be a discussion point going forward, and I don't know what that really means for the company. So definitely let me know in the comments what you guys think about big tech in 2025, or maybe Apple, or even UNH, if you have some thoughts on it. Now, if you want to see my other thoughts on what I think is going to happen in 2025 in the market, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building, stacking wins, and I'll see you on the next one. Peace.